want you to imagine a financial superpower that actually allows you to profit whether a stock is going up, it's going down, it's going sideways, and it costs less than using the actual stock. Well, that is options trading. Now, options, these are just financial contracts that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time frame. And these contracts are essentially agreements between two parties. And it allows an investor or a trader to speculate on an asset price without actually owning the asset itself. Now, there are two main types of options that beginners should know about, and these are called calls and puts. The call option is going to give the buyer of that call option the right to purchase an asset at a set price, while a put option provides the right to sell at a specific price. So let's imagine a trader believes that ABC stock is undervalued and it's going to go up in the future. So they may purchase a call option. It gives them the right to buy shares at a predetermined price, and that's known as the strike price. On the other hand, another trader thinks ABC stock is overvalued. They may actually buy a put option. Now, options, these are not free, right? The buyer of an option pays a premium to the seller for taking on the risk. This premium is influenced by a bunch of different factors. The option's intrinsic value, how much time is left, and the implied volatility of the underlying asset. Now, one of the most appealing aspects of options trading is leverage. These small movements in the underlying asset price can lead to big changes in the value of this option. So this means that options traders can potentially amplify their gains, but also note that losses can be magnified as well. Now, there are more than a few strategies out there for profiting with options. Let's just talk about two of them. One, very basic, covered call strategy. And this just involves owning the underlying stock while selling call options on the same stock. So this approach is going to generate passive income through the premiums that you receive, and it doesn't matter whether that stock goes up or down. Now, a cash secured put. This is another popular strategy. Here, you will set aside cash to potentially buy a stock at a discount while earning premiums in the meantime. Now, if that stock price does not fall below the strike price, you keep the premium. You do not have to buy the shares. Now, of course, there's the easiest ones that we already talked about, just buying a call, buying a put. You don't need to own the underlying asset at all. You're just betting on that direction. Now, options carries risks like all trading does. And the limited time frame of options, this means that the timing is important. So for a call option to be profitable, that stock price needs to move beyond the break-even point, which includes the premium paid, and it's got to do so during a span of time. Now, beginners often ask, how can I start trading options safely? And the answer to that is education and practice. You really want to research and analyze the trends of whatever you're looking at before you make any trade. You want to learn how to diversify your approach by using different strike prices and expiration dates. And a lot of experienced traders just recommend practicing with paper trading at first or virtual accounts before you put real money on the line. Now, risk management, again, so important in trading. And traders generally limit their risk to about 2% of the capital they have per trade. So this approach is going to help protect you against big losses, and these can happen in options. Now, successful trading just requires a system that has a positive expectancy. You got to keep learning, and you have to have an understanding of the underlying asset that you're really trading. So it's not just about predicting the direction of the market or the instrument. It's about understanding the nuances of options pricing and positioning yourself to profit from different market scenarios. And a 5-step process to get started. Number 1, set up a brokerage account. Just make sure you choose one that offers options trading at a good price. Make sure you educate yourself. And a lot of these brokerages are going to give you educational resources. Select a strategy. Just decide on a basic strategy like a covered call, a cash secured put, or just buying calls and puts just to get your feet wet. Paper trade it. Practice with a virtual account to test your strategy. You don't want to risk real money right now. And start small. Always start small. When you're ready, begin trading with small amounts. Gradually increase as you gain experience and confidence. Now, one big common mistake, do not ignore expiry dates. You got to know when the contract you have is going to expire. And just make sure you diversify across different instruments. Now, options provides a powerful tool for traders and investors to potentially profit in a bullish and or a bearish market. But they do require study, practice, and risk management. And you master these contracts, you open up a whole world of trading possibilities that go far beyond just buying and selling stock.